so much, everybody, for joining us today for this webinar on becoming a private money lender with your self-directed IRA. And joining us in just a few minutes is our guest, Dave Shaw. But quickly, I just want to give you guys kind of a little bit of background on myself and Advanta, and we'll talk very briefly about self-directing your IRA and making those investments into mortgages and joint venturing with a self-directed IRA to give you an idea of the rules and the process and different types of accounts that can be used for self-directed IRAs. And before I get started, I do want to mention we do keep everybody on the webinar muted, so if you have questions, go ahead and type them into the chat box and we'll get your questions answered as we go. My name is Larissa Greene. I've been with Advanta IRA for nearly 7 years now. I've been doing education for about probably 5.5 years. Before that, I was doing back office work, anything from transactions to opening new accounts. So I'm very well aware of the process involved, anywhere from opening accounts to helping our clients make those investments with their self-directed IRAs. We are a self-directed IRA firm, meaning that we only hold investments outside of the market, and I'll talk about that in just a second. But we have 2 offices nationwide. We're in the Tampa Bay area of Florida and also Atlanta, Georgia. And we've been doing this for over 15 years. We have agents with us that have 20+ years of experience in this industry. What makes us different from our competitors is we do assign all of our clients an account manager, meaning that they'll have personalized service regardless of whether you're a mile from our office or 2,000 miles away. We have clients nationwide and even worldwide, and they're invested worldwide. So we've seen pretty much any type of investment you can think of as it pertains to self-directed IRAs. We do not give any tax, legal, or investment advice. We're going to talk very, very briefly about the different types of investments. In some of our seminars, we do talk about the rules for self-directing your IRA, but we can't tell you whether or not we think an investment is good for you or bad for you. So you do want to do your due diligence and make sure that you're comfortable with the investment that you're making. And we're going to have Dave talking about how he makes determinations on investments and how you can pretty much put a loan program together that you're comfortable with and how he's done so over the years. And so if it's not a question that we can answer, we'll put you in touch with individuals that can answer your questions. We have a lot of attorneys, CPAs, and individuals like Dave that make investments on a daily basis, and we try to put those educational programs together with those individuals for you. If you're not sure if we can answer your question, go ahead and ask it anyway, and if not, we'll put you in touch with somebody that can help you. We do educational webinars and seminars all the time, always at no cost, no obligation. Our webinars are just about every week. We do live seminars at our offices every other week. So please make sure that you check out advantaira.com/events for the calendar of events. We have a lot of great workshops coming up where we're having investors join us, talking about their investment strategies, and also professionals. For example, coming up in June, I have another webinar with an attorney talking about landlord-tenant law. I also have another investor that will be joining us at our Largo location in Florida, talking about different investment strategies that they use for making investments. So if you're interested in learning about those, make sure to email or call us or check out advantaira.com/events for those. We also do post all of our webinars. Once they're completed, we record them. Once they're completed, we post them on our YouTube channel, so you can check out Advanta IRA on YouTube for any of those webinars from the past. And we have, 50+ webinars on there, and they're all great. A lot of people haven't heard of self-directed IRAs just simply because there's not a lot of self-directed IRA firms out there. Charles Schwab, Fidelity, Morgan Stanley, those are all great companies, but they've made it a business decision basically that they don't want to hold anything outside of the market. They consider those assets hard to value, and they're not set up to receive rental income or pay mortgages or receive interest payments on behalf of an IRA, and so they just simply won't hold those investments. But that's actually, where we come in. We don't hold anything that is invested through the market, so, we've kind of made the reverse decision, and we'll only hold private investments like rental properties or private mortgages on behalf of our clients. Many times people think that they have to have a Roth IRA in order to self-direct it. And actually, anything that ends in IRA can be self-directed along with many employers' plans. So if you have a 401k, a 403b, in Florida we have the Florida retirement system. Any of those plans can be self-directed with those, but just check in with us, find out how you make the move from holding, something invested in the market to private investments, and we can help you with those. I also have listed up here education savings accounts and health savings accounts, and although those are not retirement accounts, we can help you with those because the rules for self-directing those types of accounts are the same, and so we hold those here at Advanta IRA. And if you're wondering, how do you find out if you can qualify for a health savings account or to sponsor an education savings account on behalf of somebody, let us know and we can help you figure that out. Self-directed investments, with them, the sky is really the limit. So there's only two things that you can't invest in with a self-directed account. That's life insurance and collectibles. And outside of that, there are some people you can't transact with. But for the most part, investments, that you may be making personally every day, you may be able to do with a self-directed IRA. And because the IRS has not provided us with a list and said this is the only, this is the only list you can choose from for investments, what I like to do is give you an idea of investments that we see here at Advanta so that you can kind of understand that, really as long as it's for investment purposes, it's likely something you can do with a self-directed IRA. Real estate is the most common investment we see. And it can be commercial or residential. You can buy and hold, rent out a property. It can be a vacation rental. You can rehab, fix and flip a property if you want to. Those are all acceptable investments. And again, there are some rules involved that we're not going to go into today, but if you're curious about those, join us for another webinar, send me an email or give me a call and we can go over those rules. The paper side of investments, which we're going to be talking about with Dave in just a minute, mortgage loans, buying, lending money and letting somebody buy a piece of property, having your mortgage secured by the residential property or commercial property. You can do that, and the great thing about lending money is you're going to be the bank, and I'll talk about that in just a second. We do see people invest in tax liens and tax deeds with a self-directed IRA, and for us here in Florida, in our immediate area, it's just about tax lien season, so if you're familiar with that, the counties are going to put the liens up for auction basically on their website. For us, it starts at 18%, and the unique thing about a tax lien is that you're bidding down from the initial start at 18% interest and going from there. So we're going to see, a lot of people doing those transactions here in the Pinellas County, Hillsborough County, Pasco County area in May and June for us. So if that's something you're interested in, you should check with the counties that you want to be invested in and find out when they put their liens up for auction and also what their process is for each county. Unsecured notes, I think a lot of people find this a very unique strategy, but remember, we're not giving you any investment advice, and the IRS does not put restrictions on whether or not it has to be a secured loan. So if you're comfortable with an unsecured note, it is certainly something you can do. It can be a first mortgage, a second mortgage, a third mortgage. Again, if you're comfortable with that investment, then that is certainly something you can do in a self-directed IRA. Do your due diligence and then bring us the paperwork and say, hey, I'm ready to make this investment, and we'll help you get it done. You can do option contracts, something that is considered maybe a little bit more of an advanced strategy for investing in real estate, but we certainly do have clients who are comfortable with that investment, and they're doing those types of investments, sometimes short-term, sometimes long-term, completely up to you. Assignments, so, very simply assigning a contract, a real estate contract over to somebody. When we see people do those, you might use just a couple $1,000 for earnest money, put that down to secure the contract, and then find somebody who wants to buy the contract from you. And then joint venturing, lending money and maybe charging either no interest or a smaller percentage on your interest rate and then getting a portion of the upside. So, whether you require your borrower to have some skin in the game and then you want, a third of the upside when that property sells, all of these things are going to be determined by you as the IRA holder, and you're going to just let us know when you're ready to make that investment what the structure of the deal is going to be. And then other alternative investments, LLCs, whether that's investing directly into a company or using an LLC for checkbook control of your IRA. We also see people investing in precious metals. Private stocks, something like a local bank, a restaurant, a brewery, even fast food restaurants we see as private stock, all things you can do in an IRA, and then some commodities. So again, we won't hold anything publicly traded, but if you're investing in something private, that is something that we can help you with. Types of private lending, as I mentioned, a traditional mortgage, so lending for 15, 30 years, whatever it is that you find acceptable. You're going to come up with the terms and let us know. It can be short-term lending, transactional funding. It can be, 6 months, a year, 5 years, whatever it is that you deem acceptable for the investment. Unsecured promissory notes, as I mentioned. You can do equity participation or joint venturing, again, getting a portion of the upside when a property sells, or notes secured by things outside of real estate, so farm equipment, automobiles, livestock. We've seen all of those things. So when you're ready to make that investment, you would let us know, hey, I looked into this. This is how I want to structure the deal, and then we'll help you put it in the name of the IRA and receive any payments that apply. The great thing about lending with an IRA is that you do get to establish all of the terms. So that means that you're going to determine how much you're willing to lend, the interest rate at which you're looking to lend at, the length of the term, whether or not this is amortized or interest only. Are you getting equity participation? And when is the payment due? Is it a monthly payment? Is it a quarterly payment? Or is it a balloon payment, one payment at the end of the year? The interesting thing about a mortgage is it's almost like having a bank CD, but with maybe better security and a better interest rate. And the good thing about, lending with a private money lending in an IRA is you are determining the rate at which your IRA is going to grow. When you go to a bank, they're going to determine, all of these things that we're talking about now. And so when you are the bank, essentially, you're going to get to make those determinations as well. And, a lot of times real estate investors kind of consider lending money a low maintenance asset because, they don't have to deal with tenants, termites, and toilets when they have this asset. It's basically, putting money into something, having it secured, and then just sitting back and receiving payments on the loan. And so it can be a very good investment strategy if you don't want to have to worry about tenants in your IRA. So before I turn this over to Dave, I'm just going to give you an idea of how this works in an IRA with a case study. First mortgage, Paul is going to lend money out of a former 401k. He determines who he's going to lend money to, and he sets the terms for the loan with his IRA. Basically, Paul will open his self-directed account with Advanta and move the money over from his old 401k by rollover, so letting the 401k administrator know that he's rolling funds into an IRA. They'll cut a check directly to the IRA. Advanta will deposit it. We'll review the loan documents, they'll review the loan documents, making sure that the lender in this case is the IRA and not Paul personally, so that's very important. And so the lender will be demonstrated by Advanta IRA Services, LLC, for benefit of Paul's IRA. Once that's done, we do have Paul read and approve all the documents with his signature so that we know he is agreeing to the terms on the paperwork we've received. And once that's done, we'll fund the loan, and the mortgage will be recorded in the name of the IRA. Going forward, the borrower will send the monthly interest-only payments in this case over to Advanta. We'll deposit them to Paul's IRA account and record them as interest payments to the loan. Paul can track those payments by email. He'll receive email notifications that we've deposited the payment, and he can also pull up statements online for those investments. The borrower decides to sell the house. When the property sells, Paul's IRA will receive the full payment amount determined by Paul. So if this wasn't interest only and it was amortized, he would provide the final payoff number to us, and we would then put that together with Paul and the borrower. And then once that's completed, the money is received and Paul is ready to make the next investment. So as you can see, if you're already familiar with lending money personally, then the strategy is very similar for your IRA. It's just that the IRA is the lender and the money is going to go back to the IRA. And those 2 points are very important, but we're going to help you get that done when you're ready to make that investment. So with that, I'm going to turn this over to Dave. How you doing, Dave?
I'm doing well, thank you.
So Dave is a private money lender, and he does some other types of investments. He's going to go through the program, and like I said, if you have questions throughout the seminar, go ahead, type your questions into the chat box, and we'll take some questions as we go, and then, of course, we'll allow for questions at the end. Dave?
Thank you, Larissa. Bear with me. This is the first time I've done a presentation in this manner. I usually have done them face-to-face, so this is going to be a new experience for me. I think the biggest challenge I found initially getting involved with private money lending was finding the opportunities. And to start that's kind of the biggest thing, is how do you find the opportunities? And these are the ways that I was able to network and find investors that were looking for funds, had properties they wanted loans on, and it also provides an opportunity to feel out these people relative to other people's opinions. We don't use credit scores and the same mechanisms that bank uses. We use other people's information as well as the properties themselves. So these meetings are here, all local here to Florida. But if you're out of our area, if you go to the meetups or look for your local RIAs, you can usually find different organizations that you can meet face-to-face and visit. I do visit the ones in Minnesota when I'm visiting up there. I've got family up there, so I like to take part in those as well. And it's a good idea.
To Dave's point there, Dave, I just want to mention, for people that aren't familiar with RIA groups, it's a Real Estate Investors Association, and they are nationwide. So if you're not familiar with that, you can just go to Meetup, put that in on the search for your area, and you're going to find a lot of these groups. They provide, sometimes they're free, sometimes they have a minimal charge. They provide good education and very good networking. So if you're not familiar and you want to kind of, get in tune with the investors in your area, this is a very good way to do it.
Thank you, Larissa. It's a good way to kind of fill out what the other markets are like. Again, these are more meetings that we have in our area. And after you start going to one, you kind of find the other ones that may not have the designation as a RIA, but they are more folksy type groups, less structure, but just a chance to meet people and network with them and share your ideas and find out what theirs are. Again, it's networking. There is, as a private lender, we don't really advertise other than by word of mouth and by explaining what you've been doing and talking to other people about what they're doing. Larissa mentioned the due diligence part. That is our responsibility as the lender of our self-directed IRA. The beauty of it is we're not like a bank that we have volumes of loan criteria and loads of people to run everything by. You have to decide what you are comfortable with and what you want to do in terms of your loan criteria, your loan to value. I like to look at things between 65 and 70% loan to value. I predominantly do first mortgages. I have done second mortgages. There again, it depends on the property and it depends on the person. Term, the time period you want the loan for. I don't do long-term loans. I do flips that are usually a 6-month or a year maximum. My long-term loan is usually 3 to 5 years. My thinking is that the borrower would be better off putting their properties in a portfolio and finding a portfolio lender at a lower interest rate than they're paying me. You establish the minimum rate of return. What do you want your funds to return back to your IRA, and how do you want that to happen? Well, you charge points. Points are, in a bank situation, they always charge points for all their administrative work they do and for all the other fees that they have. I include usually 2 points, sometimes 3, depending on the loan, depending on the work that has to be done in the due diligence process with the property and with the individual. Prepayment penalty. I always establish a prepayment penalty, primarily because once I take the money out of my self-directed IRA and loan it, if it comes back too soon, I have to place it again. And then you have that gap in there of the time that it was paid back until you had a new home for it. My flip loans, my short term, it's minimum 6 months. My long term, 3 to 5 years, it's a minimum of 1 year. That's what I call, and when I say minimum of 1 year, it's minimum of 1 year's interest or minimum of 6 months interest. So that's my prepayment penalty. Accruing payments, that again depends on the individual and the property. Accruing payments really means that if I'm doing a fix and flip, if there's interest involved, it's not equity participation. I charge, say that it's a 12% annualized interest rate. Normally, I collect that monthly interest rate every month. Sometimes I let it accrue to the sale. It just depends on the property, the condition of the property, the length of the rehab itself. But there again, that's just something that you choose on your own. Geographic area. I like to lend where I can put my eyes on the property, whether it's long-term or short-term, in a reasonable drive. I get out quite a bit. I like to drive by the properties periodically. So, or what I have in Iowa and Minnesota, I have someone in those locations to do the drive-bys for me. So it's nice to keep an eye on them. Fees you may charge sometimes if you're doing a draw on the flips, and you can charge $150, whatever you want, $100, $150 to go out and see that the work was done on the first draw before you pay the second draw. The other fees that I like to charge is the fees that Advanta charges me, as well as the wiring charges, any of the administrative fees. Well, there's a question here. It says, what about charging of a too high of interest rate? Usury in Florida is 18%. So yeah, you have to be careful of that. But there's ways to deal with it. When we do an equity participation, the return we're getting is greater than 18%, but it's based on what the return is to the investor, and it's a component of that. It's a percentage of the upside. So a lot of time, and I guess most times, that is higher than the usury rate, but we're not charging interest in that perspective. Well, the other question is, have you ever decided lending money to someone on their personal home so they can lend to their business, which is real estate investing? Owner-occupied homes are still not okay to do with because of the Dodd-Frank Act. They still have that stipulation that can create a lot of headaches, a lot of problems for a private money investor. You could do that if you used a broker. So there are ways to do that, but then using a broker, that kind of takes away some of your fees and your opportunities. This is a danger. Loaning to family and friends. Everybody has horror stories about lending to family and friends, and there again, it depends on the person involved. It depends on the property. I have done it. It's worked out fine. The thing you have to be careful of, and Larissa didn't talk about it, but that's a big part of when you're lending with your self-directed, are disallowed transactions. Spouses, children, etc. And the point with family and friends too, it's the difficulty to collect. And I think the terms may be different, but you also have to keep in mind when it's your self-directed IRA, in order to make it needs to be kind of fall into the framework of how you would lend to anybody else. You can't, especially if it's, you can't give, at least I don't believe you should give your family and friends a benefit, because especially with the idea that they're going to give you some sort of benefit in the future, because that could mess up your IRA.
Yeah, that's exactly right, Dave. I mean, you want to be very careful with these types of transactions. And so, when you're lending money, it is up and down your lineal tree that are considered disqualified persons, creating a prohibited transaction. So parents, grandparents, children, grandchildren, and then any spouses or business entities of those. And so, if it's not an arm's length transaction, you're going to run into some trouble there. And then if there's any current benefit to you or any of those individuals I just mentioned, regardless of who the deal is with, that is also a problem. So an example might be lending money to a friend that is then going to allow, your daughter to rent from them because of that transaction, for college or something like that. That's going to be seen as a problem by the IRS. And so you want to make sure that there's no current benefit to you or those disqualified individuals when you're doing a deal. And a lot of times if these are truly arm's length transactions for investment purposes, then you're going to be okay. But if you start getting into giving discounts or, anything like that, then you could be looking at something that might be considered prohibited, and that's when you want to, either give us a call and find out if it's within the rules, and if we can't answer that or make that determination for you, then we would refer you to an attorney, because you do want to make sure that you're within those parameters when you're lending from your self-directed IRA. And I did see a question pop up on if you can lend to yourself, and as Dave mentioned, the IRA holder is a disqualified person, and with an IRA, you can't lend money to yourself, even if it's on a rehab project and you're charging interest that's fair market value. It's just simply not allowed. With a 401k or an employer's plan, you can do a loan to the participant that's structured different than something like a mortgage or a joint venture. So with a 401k, you can do a participant loan. It does have to be a structured loan, but that is something that you could potentially do. But with an IRA, unfortunately, you cannot lend money to yourself in any manner.
Yeah, I think the term that's used is self-dealing. And, if it feels like you're self-dealing, if you're dealing just with yourself, it's not recommended. Jeff Watson, who is an attorney and also a lobbyist for real estate organizations in D.C., he's got a website, and he sends out weekly, sometimes biweekly emails talking about real estate investing and things that he's run into as an attorney. And if you want to get his website, it's on the bottom of the slide. It's jeffwatsonlawfirm.com. And these statements came out here, I don't know, probably 6 months or a year ago, but it kind of falls into what we're talking about. Lend on the basis of both the person and the deal, but the deal matters more than the person. And that's self-explanatory, but it's the equity that you have in the property. And even if that person is gone, are you still going to be okay? Absolutely insist that all your lending criteria be acknowledged by title and escrow. Use a title and escrow company that you have selected or personally vetted. For me, that's premier. There are fewer title companies that are familiar with private lending, at least I've found. We've got a couple here that are phenomenal. They understand the process and they understand the needs of both the borrower and the lender. So I recommend that you find, and as I say, you vet them to make sure that they understand what private lending is and how that process works, and how it works with a self-directed IRA, and how the wires are done, and how the documents are taken title of. Be quick to question procedures and verify the accuracy of information, and be slow to fund. That's when the title company sends you all the documents, and I do my own mortgages and notes, but make sure that they're all checked over, verified. The HUD statements, the title insurance, the hazard insurance, everything is in the correct names. It's so much easier to make sure it's all done correctly prior to closing. Make sure all of the protections that are available to you as a lender are properly in place. And there again, that's the title insurance, the hazard insurance. Your IRA needs to be listed as on the title insurance and on the hazard insurance as additional insured. So if anything happens, you're part of the contact process. Evaluating the loan. I see there's a question here from Ronald. I'm gonna move on and we'll just hold that one. Evaluating the loan. These are my questions that I ask myself. Would I be happy with owning the property for the amount of the loan? Do I like the neighborhood? And the neighborhood is one of the most important elements when I look at a property. A lot of the property that our investors find are usually the worst property in the neighborhood, which I like because they're going to make it better. But if the property that they're wanting a loan on is in a neighborhood that has many more houses that are in similar condition, I don't feel as comfortable with. Do you agree with the borrower's value assessment? That's always a question you have to ask. I always do my own value assessment, appraisal. Everybody's got their own opinion of what it takes, what the property is valued at, but there's different ways to go about doing that. And if you have a realtor on your team, it's a good way to do that. Get a CMA from them after you have inspected the property, so you know what it's going to look like when they get done. So you have an idea what it's going to take to get it fixed up. If it's a flip, review and validate the budget. That's critical because many people, or some people, have a tendency to put more money in the property than the value, the after repaired value will support. So you need to be, have your own sense of what it's going to cost to replace a kitchen or replace a bathroom or paint the property or do the floors. If it's a rental property, review and validate the lease, the rent terms, the rent rates in the area. Those are all, there are Rent-A-Meter, different websites that can give you that information. Closing requirements, all part of getting things together for Advanta to do the wire. And these are dependent upon what kind of deal you're doing. If you're doing a purchase in your IRA, you need the purchase agreement. In all cases, you need a HUD, whether you're lending or whether you're purchasing. They're called closing statements now. They said the HUD was too complicated, and now they created a closing statement that I think is more complicated. Hazard insurance, additional insured, we talked about that. Title insurance, note, mortgage that I provide. I always write those myself. Know the closing agent company, we talked about that too, and follow up to see that recordings are done timely. These are all items that, along with the forms for Advanta, does all have to go into Advanta for them to generate the wire transfer for either the funding of the loan or for the purchase of the property. Just a comment on the timely recording, you do need to follow up. And usually in this electronic world, or even using mail, it can take up to 2 weeks to get it recorded, depending on the county. Well, we did have a situation where another investor and I were working together, and we did a flip on a property. We purchased it and did the closing, and the closing, the title company recorded the title in the wrong county. And you would think that the county that was recorded in would automatically reject it and send it back since it was the wrong one, but that didn't occur. When we got the property rehabbed and a contract on it, that's when we found out that it had not been recorded in the proper county. So, like I say, it's worthwhile to make those, take that time to just look at the website and make sure that the title has been recorded. Part of follow-up every month, and the nice thing about Advanta is that they send you an email when you have payments made on your accounts. So I've got a spreadsheet that I check off every month on all the payments that I receive. And if they're not there on time, I contact the borrower and ask them what's going on. We've had a couple instances where the U.S. mail didn't get the check through, and we had to stop payment and issue another one. But it's easier to do on a monthly basis than if you don't follow up for 2 or 3 months or 4 months, and then you've got to try to catch up. And part of that is communicating with the borrower on a regular basis. I mentioned the drive-bys. If you see something wrong on a drive-by, call the borrower, or just call them every once in a while just to check and see how they're doing. I had a situation last year where I had a mortgage on a little property, and the guy missed payments for a month, and I called him, and he said, "Yeah, I'm struggling. He's stage 4 cancer. He's going to chemo." I said, "Okay, I understand." So another month went by, and he still wasn't able to pay. And he said, "Well, my tenant left, and it needs work." Okay. So we did a deed in lieu. He deeded it back to me. I had another investor that we did a quick claim deed to, and it got the guy with cancer off the hook, and it got me off the hook, and it got the investor a good property. So everybody was satisfied. But part of that is communication. On the fix and flips, track the progress, again, inspect, and drive by the rentals. These are some examples of loans that I've done. And there's like we were talking earlier, there's many ways of doing these. And the beauty of it is you get to decide your own ways. And as I say, it's always good to talk to other people. I mean, I don't find there is any competition among investors in our area. Everybody's willing to share and help one another with questions. But in this example, it's a $150,000 loan for a purchase with a $50,000 rehab. Now, the borrower is going to have the $50,000 for the rehab. The after repaired value, or ARV, is $275,000. So it's a 75% loan to value on the interest. It's a 55% loan to value on the ARV, which only means that if the ARV value is right and you've got 150 in it, your loan to value is 55%, which is a good return. I mean, it's a good ARV, loan to value. 6-month minimum, we talked about minimums, 12%, 3 points, sometimes get 2, it depends on the property, the situation, the turn time. Borrower pays Advanta fees. So in this case, the interest in 6 months for 6 months is $9,000, $4,500 in points. Closing costs at sale at 10% of sale price. That's kind of a easy bogey to figure out, that when you sell a property for $275,000, $27,500 is going to be closing expenses, whether it be real estate fees, the cost of title insurance, all these other fees that go along with that. So in this case, with the lender earning $13,500 in interest and points, that still leaves the borrower with a $34,000 upside, which is in a 6-month period for a $50,000 investment and their time. Not too bad.
And Dave, before you go on, we did have another question pop up here. Is there any challenge with lending to an entity, an LLC or a trust, as opposed to lending to an individual investor personally?
Well, that's up to you. You know, that, as we said, we set our own guidelines. Most of my lending goes to land trusts, and in a land trust setting, and the reason that land trusts are used is it's the land trust that goes on public record, not the individuals. And you'll find that experienced landlords never put their name in public records because of the exposure for lawsuits. So I lend to land trusts primarily because of the borrowers I deal with. I do lend to LLCs as well, but I know it's one of those things where with a land trust, it's the land trust has a trustee that signs everything, but they are not required by law to say who the beneficial interests are, who actually owns the property. But if I know who those people are. I mean, that's part of. I mean, I don't have necessarily have the land trust in my hands, but I've seen the land trust, and I know who the beneficial interests are. So I do lend to LLCs and trusts. And if somebody wants to borrow personally, I actually discourage it, and that kind of gets back to the owner-occupant again. If they want to put it in their own names, I get an affidavit from them saying that this is not going to be their personal residence. So that protects me from Dodd-Frank.
We have another question pop up here, Dave, with do you hold your IRA in the name of an LLC or a trust?
I do not. There are. I know a lot of people that have checkbook control and put their IRA funds in a trust and an LLC. And I've looked at that. I look at that almost annually, but I don't see the benefit of me taking over all that bookkeeping when Advanta does such a nice job of it. And that's the upside for me to move those to a checkbook control is I can reduce the fees that Advanta charges. But the downside of that, I have to take over more of the responsibility of the paperwork and the management of that. So how I look at it is I would rather spend my time earning and less time doing the administration. So, and Advanta does such a good job, like I say. Some people say they like checkbook control because they can write a check today if they've got a deal. Well, I can get a check from Advanta tomorrow. So I've never run into the problem where that was caused me to lose a deal.
And that's a good point because, I mean, ultimately, the way you structure the deal, whether you have your IRA in an LLC or a trust, and then that LLC or trust makes those investments, it's all about what you're comfortable with and what you really want to take on. So, we are record keepers. That is our job. If you want to take record keeping out of our hands, you can certainly do that. And I would say, I mean, it sounds really amazing to people sometimes when they first start thinking about checkbook control, but when they see all the record keeping they're going to be doing or the responsibility that comes along with it, I would say probably around 50% or less of our clients that are making these types of investments, even when they are essentially on the spot, they're only about less than 50% actually doing it through an LLC or a trust. So that kind of gives you an idea of what we're seeing here at Advanta. But if you're comfortable with that and you're ready to take on the record keeping, you can certainly do it. I think it's all about preference. If you wanted to gain some anonymity, you could simply leave your name off of the documents and just use your account number. So if that was primarily the reason you wanted to do it, there is a way around that as well.
Well, and the other point too is I would lose the oversight of Advanta, and Paul Hutchings is my account manager, and all he has to say is, "You want to do what?" Which makes me think. So that's why I like it, and to me it's worth the expense.
And we would ask you for those documents, as Dave kind of outlined, what we're looking for, what we require in order to, go to closing and fund the investment. And so, if you, aren't sure what documents you should have for record keeping, if you're just kind of getting started and you're not familiar with some of the legal documents, us very simply sending you an email with all of the requirements we're going to have to go to closing is going to be a good start, a good place for you to start in knowing what you're going to need going forward, and maybe working, if you haven't worked with an attorney, this is, your first lending experience, maybe you want to, but at least that way you can take the list of those documents to your attorney and say, hey, this is what they're going to need to get started on this investment. And so that'll give you a good idea. If you have checkbook control, nobody's going to give you a list of what Advanta would require because you're taking on that responsibility and taking those requirements kind of out of, the necessity list there. And so you're not going to be as familiar with what that looks like to go to close. And so we're not going to say to you, okay, within your LLC, what investments are you making? What documents can you provide us? We don't need any of that stuff because we're only holding the LLC directly through the IRA. So that's something to consider as well.
Well, and I've always heard, I don't know if this is fact, but the checkbook control IRAs are more visible to the IRS because of the lack of controls. I don't know if that's a fact, but what you lose if you make a mistake, your whole IRA is polluted. So they're gonna make you convert everything, pay taxes on it, and move it. So to me, it's not worth it. That's just me. I guess I would rather do paperwork that made me money rather than the small expenses that are involved. Anyway, back to example 2. Fix and flip with equity participation. And we were talking about that relative to the usury rates. $200,000 loan for the purchase and rehab. Now, that's important because this particular situation, the borrower brought the deal to me, but he didn't have any money to do anything. So it's all my IRA's money that's going to make the loan. So they don't have any skin in the game. After repaired value is $275. Loan to value on the investment is 100%. Loan to value on the ARV is 73%. So how we structured it is 6-month minimum, 8%, 3 points, and borrower pays Advanta fees, which means $8,000 interest in 6 months, and the 3 points of $6,000. The closing costs at 10% of the sale price. Again, that's just a bogey that is easy to use. $11,725 is 35% of the net. So, and then the borrower gets $21,775. That's the borrower's earnings. Now, the borrower had only the house, only the house under contract. He had no money in the deal at all. So his earnings were $21,775. My earnings, or my IRA's earnings, was the $14,000 or the $8,000 in interest for 6 months, the 6 points, and then the $11,725. So my IRA earned more, but my IRA had all the money in it, all the funds in it. And I didn't figure what the rate of return on this, but this is greater than 18%. But it's not usury because it's an equity participation. It's sharing in the upside, not charging interest. Rental properties, this is how I normally do a rental property. Loan amount $150, estimated property value $225, loan to value 67%, 10% interest rate, multi-year, $1,250 per month. Always know the rent rate in the area. So, because it's when you're making a loan on a rental property, you want to make sure that your borrower is going to cash flow for sure. So you need to know what the overhead's going to be on top of the interest and what the rent rates are going to be. Because primarily all my notes are interest only. I will do I will amortize on rental properties, but a lot of times that will conflict with the cash flow for the individual. Rental property variation, I've done this too, is we do a lower interest rate with a participation in market appreciation. That's if you're in a hot area, in a hot market, I mean, this is always something to consider. But it's like anything else, the market can go down rather than up, and so, but you still got your interest. What do you want to do? Now this is kind of when I've done this before live, and a lot of people, I don't know how many of you are 8 to 5 workers, and it's difficult to always especially do the network, do the inspections, do the follow-up, and that type of thing. So do you want to be an active lender? Then you have to find the opportunities, do the evaluation, lend, close, and follow-up. Those are all an active lender responsibility. Passive lender, use someone to present you with the opportunity, provide the decision data for your decision, and close and follow up. I've got passive lenders I work with as well. uh, family members and friends. That's how they like it. I mean, once are my daughter and son-in-law, and they don't have time to chase this stuff around, but they certainly do like the returns that they get on their investments into their IRAs. What's next? More webinars, live discussions from Advanta. Oh, I forgot to take this one out. On occasion, we have, there's 3 or 4 of us that have private lending socials just to talk about opportunities and the processes to give you a face-to-face. And usually these are in the evenings. The last one we did was in January of this year. Currently, we don't have any scheduled at this point. See, are there any questions here that?
We did have a question pop up. For lending on a rental property to be safe, what is a good rule of thumb for borrowers' cash flow over and above the loan payment monthly?
That's a kind of an arbitrary. I like $200 a month, but I also like to look at how they're accounting for all their costs, as well as the interest they're paying. Again, and it's not that I don't trust all these people that I do business with, because if I didn't trust them, I wouldn't lend to them. But everybody's got a different way of looking at things from different perspectives, from different experiences. So I like to see those numbers just to make sure that's. But $200 plus or minus is usually a good. It makes me feel good because they've got some cash flow, and what they're banking on by paying interest only, they're banking on appreciation. And in our market today, that is still a viable objective.
Okay, if we have any other questions, we'll give you just another few seconds to type something into the chat box. But I'd like to take a moment just to thank Dave for joining us for this webinar. And as I mentioned, it will be recorded, and because you guys all did register, you will get the recording for that. Basically, what we do is we put it together, we get it up to our YouTube page, and then we'll send you the link for that so you can review it at a later date. If you want the slides from the presentation, just make sure to email me, and I'm happy to share them with you. I do need to get an email from you because I don't share those in the email that goes out. So let me know. And if you guys have any questions, if you need any references, anything like that, please do send me an email. I did get a lot of requests during the webinar, so please send me an email because I don't have the ability to write all of those requests down. So, and then I did have somebody just ask for my contact information. Again, my name is Larissa Greene. My email address is the first initial of my first name and my last name, Greene, LGreene, at advantaira.com. Again, that's LGreene at advantaira.com, or you can call the office and just simply ask for me. And then you can let us know. Again, if you want the presentation, please send me an email because I did get a lot of requests. And then go ahead and, let me know if you need references or if you have additional questions. I didn't see anything else pop up. So with that, I'd like to thank Dave. Thank you so much, Dave, for joining us for this. And we look forward to having you on again.
Larissa, I did see the one question that Mr. Boyer asked about cash flow. And when I say $200 cash flow, that is net the deferred maintenance account that people set up. Normally you figure about 45% of your, well, there's a lot of numbers go in that, but when I'm talking about cash flow, it includes money that has already been, is net money that's been set aside for maintenance type items like replacing a water heater. So it's kind of a depreciation account, if you will, things that are set aside.
Okay. 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 I don't see any other questions, so thank you for clarifying that for us, Dave. And thanks again for joining us for the webinar, and I look forward to seeing you at some of the meetups.